Welcome to The Explainer. Today, we're going to unpack the really unique investment philosophy of Quant Mutual Fund. They believe that a lot of the conventional wisdom out there might actually be holding investors back. So let's dig into their latest fact sheet and see what they mean. Okay, let's just jump right in with a statement that's, well, it's pretty bold. Quant points to academic research that suggests while a lot of managers are great at buying stocks, their decisions on when to sell often fall short. So short, in fact, that a completely random selling process could actually do better. I mean, wow, that really challenges the entire idea of active management, doesn't it? So if that's the case, it really begs the question, right? If the pros are struggling with when to sell, what is the one critical piece of the puzzle that almost everyone seems to be missing? And for Quant, the answer is crystal clear. It's all about timing. They argue that the entire industry is obsessed with fundamental analysis, buying the right company. But they're neglecting the single most important variable, when you buy and maybe even more importantly, when you sell. This slide just lays it out perfectly, right? You've got two totally different ways of thinking. On one side, you have the traditional perpetuity mindset, this idea of buy and hold forever. But Quant argues that can lead you straight into value traps. On the other side, you've got their dynamic model, which is built for a world that's constantly changing. For them, being able to adapt isn't just a good idea, it's absolutely essential. And for them, timing is everything, isn't just some poster on a wall. They see the proof everywhere, from how the U.S. Federal Reserve makes interest rate decisions to how the global financial system works. They believe any investment decision is completely tied to its timing. And that idea, well, that's the heart of their entire system. All right, so this is where things get really fascinating. To understand the why behind their strategy, we've got to go way back, like ancient philosophy back. Their whole view of the market is inspired by three core ideas from Vedic philosophy. This is just brilliant. They've essentially created a blueprint, mapping these old-school concepts directly on today's markets. They see Atman, the true self, as a company's fundamental value, its real worth. Prana, which is like the universal life force, becomes liquidity, the flow of money that makes the market tick. And Maya, the illusory world, well, that's price itself, always changing based on our emotions and perceptions. Okay, so you've got this really deep, kind of abstract philosophy. The big question is, how do you actually turn that into a disciplined, repeatable process for investing real money? Well, they've built a hybrid model to do just that. They've got a name for it, quantum mental investing. And no, this isn't about just letting some computer algorithm take over. It's about finding that sweet spot, that perfect harmony between hard, objective data from their systems and the experienced human judgment you need to actually make sense of it all. And here's how it all comes together. It's their VLRT framework. Think of this as the engine room. It's constantly analyzing how valuation, the Atman, liquidity, the prana, and risk, the maya, are all interacting with each other across time. This engine is what turns that ancient philosophy into modern, actionable timing decisions. All right, enough theory. Let's see how this whole philosophy actually plays out in the real world, with real decisions and what they're seeing in the market right now. So when they run the numbers and apply their VLRT framework, what do they see? Well, they see one thing, crystal clear. The next decade belongs to India. They're not just kind of hopeful. They are decisively, strongly positive on the Indian market for the long haul. And this isn't just a hunch. They're looking at India's Atman, its fundamental strength, and the data is just screaming. We're talking 7.8% GDP growth, which absolutely smashed expectations and was the fastest growth we've seen in over a year. And what about the prana, that economic life force? It is absolutely surging. The manufacturing PMI, which is a key measure of factory activity, hit a level we haven't seen since way back in early 2008. That points to some serious momentum in the economy's core. Okay, so check this out. This is a perfect example of their timing in action. In their multi-asset fund, they were sitting on about a 10% allocation to silver. Pretty standard. But then, bam, their framework signals a shift, an opportunity. And they didn't just nibble, they tripled down, jumping all the way to nearly 30% exposure. Now, that is not a small adjustment. That is a major, high-conviction move driven entirely by their signals about timing. Now, you can't run a dynamic strategy like this without a rock-solid foundation, and they've been busy reinforcing their own leadership team and overall governance with a couple of major new appointments.
And we're talking about some serious heavyweights here. They've brought on Mr. Rajneesh Kumar, the former chairman of the State Bank of India. You can't get much more strategic experience than that. And they've also added Mr. Nishith Mehta, a top compliance leader from Bank of America, to make sure their regulatory game is airtight.
So you've got the philosophy, you've got the process, you've got the new leadership, and it's all led to this. They're launching something new for the Indian market called a Specialized Investment Fund, or SIF for short.
So what exactly is this thing? Well, it uses what's called a long-short strategy. To put it simply, it means the fund is built to make money not only from assets that are going up, that's the long part, but also from assets they correctly predict will go down, that's the short part.
And the whole point of doing this is to get 3 key advantages you just don't get with a typical fund. First, you can capture opportunities both on the way up and on the way down. Second, you can limit your exposure to the overall market's ups and downs. And third, you can actively use hedging to protect against those sudden, sharp downturns. So, after all that, what's the big takeaway for you, for any investor watching the markets today? What does this all really boil down to?
You know, the core message here is a huge challenge to that old buy and hold forever idea. What Quant is saying is that in a world that's changing this fast, standing still is actually the biggest risk you can take. A dynamic approach that actively focuses on timing isn't just another strategy, it's become a necessity.
And that really leaves us with one final big question. A question for you, really. In a world that's changing by the second, is the way you're investing still enough? Is your strategy built to move, or is it at risk of being left behind?
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.